Let's talk a Tesla. First of all, I hate to say it, but when Elon Musk starts complaining about the Federal Reserve on Twitter, let's just say it's always been followed by poor stock performance. And what was Elon Musk doing yesterday? He was complaining about the Federal Reserve on Twitter and how they need to lower rates by 50 basis points. However, as a long-term holder of Tesla, my bias exposed, perhaps that'll create some more buying opportunities. But that's also predicated on having more cash to buy with. But anyway, let's talk about what Morgan Stanley and the Wall Street Journal just had to say about Tesla and how that could impact Tesla versus the competition. Here we go. The Wall Street Journal. Elon Musk's cost-cutting targets at Tesla pressure EV rivals. Now, I love hearing that because everybody keeps talking about how fantastic of an idea it is that basically EVs are going to have so much competition and Tesla's going to be screwed because there'll be so much competition. Part of that is predicated on this concept that, oh, well, all the other competitors are going to come out with a cheaper car and then Tesla's going to be screwed. Okay, well, let's talk about that because what do we have over here? First of all, the Wall Street Journal dives into this idea that Elon Musk's new efforts of trying to cut costs by potentially 50% for a future release of a Model 2, quote, ratchets up the pressure on traditional automakers, says here a managing director of a consulting firm in the auto industry interviewed by the Wall Street Journal. And what's fascinating to me is how this article dives right into Volkswagen and a UBS analyst, where Patrick Hummel referred to Tesla's cost-cutting plans in asking Volkswagen officials about their EV ID3. And that's because Volkswagen just on Tuesday had an event where they talked about the various different future plans for Volkswagen. And in questioning, the individual asks, hey, so y'all want to cut prices, but the reality is right now, your ID3 electric vehicle barely sells above its break-even level. How do you actually expect to make money with an even really cheaper priced car? In fact, he says, I really struggle to see how Volkswagen is going to have an affordable electric vehicle that's profitable to you in a couple years' time. The response? We are well aware that competition will become tougher, so we will try to stay as fixed as possible on the overhead side of cost. I could do that because I was born in Germany, okay? But anyway, we will have significant scale by then, referring to their 25,000 euro vehicle concept car from 2025, or that should be out at 2025. Now, let me just say this. How do you expect to get to scale on a car you haven't actually manufactured yet? If there's one thing we've learned is you start manufacturing a car first and then you get to more scale. What Volkswagen is trying to say is, hey, don't worry. In 2 years, the scale of our production will be so amazing for our break-even ID3 that we'll be able to produce a car that's about 40% less expensive because we'll finally have figured out how to not operate a money-losing business. I don't buy that at all. I think that sounds like a horrible idea, and I don't think they're going anywhere. But okay, we'll keep going here. So you've got here Caresoft Global, which tears apart vehicles to compare costs between competitors and estimates that Tesla's Model Y could have about a $3,000 cost advantage to a competitor's comparable offerings, not even including batteries. And that's today. Even if Elon Musk is unsuccessful at reaching a 50% reduction in costs, industry observers say any significant effort towards the goal would be meaningful at basically cementing Tesla's lead above its competitors. Okay, fascinating. The rest of the industry is going to stand up and notice. Now, the Wall Street Journal then jumps on over from basically going from this idea of Volkswagen actually thinks they're going to go from near break-evens to profitable on a car that costs 40% less money. Good luck to them. In the meantime, Tesla's already got cost advantages today, and on top of that are trending towards even better cost advantages. And so then what do? They compare to Ford. They compare to Ford, and they say, Mr. Farley often cites Tesla at having a more than $10,000 vehicle cost advantage per car, greater than that $3,000. It's getting even worse for the legacy auto. And what I think is great about Mr. Farley is I think he really realizes where the money is to be made and where money is not to be made. And one of the things that I think is incredible is his blatant, basically, admission of how behind Ford is. Now, some of you might remember this from the Q4 earnings call. I think it's worth bringing up again because we're about to go into a Morgan Stanley piece. And in the Morgan Stanley piece, we have some potential negative news that we need to cover. Of course, we could always balance out negative news by reminding you about the coupon that expires tomorrow. Prices go up. You get the guaranteed best price. You get lifetime access to those course member live streams and all the new content that gets added. So, but what do we have here? Jim Farley makes it very clear that they as well are not profitable on EVs. They're not expecting to be profitable on EVs until 2026. They also realize they have to go through many more cycles to understand how not to waste an extra mile of cabling on their products when they actually manufacture a car. And while they figure out how to actually get to profitability, they also realize the place to make money isn't actually on the car itself, but on software. You might remember me playing this clip of Jim Farley going, but our new, fully updated electric architecture is basically where we want to focus. Because we've learned on Pro, what we've learned on Pro is we can make real money on software. And he says it kind of a little bit creepily, but the point is, they're dreaming to be Tesla. That's the point, is the competitors are dreaming to be Tesla. And basically, the Wall Street Journal is making fun of them here. They're making fun of Volkswagen, and they're making fun of Ford by showing they're not even close. Now, look, even GM suggests our aim is to have industry-leading margins. They don't. They don't break out what their margins are because they're probably so miserable. So Ford, GM, and Volkswagen, they're not competitors to Tesla. Now, there is a risk factor, though, and Morgan Stanley believes the risk factor, despite having a 220 price target on Tesla and holding an overweight rating for the stock, which means they like it, they believe that EV price cuts are not a fad, but instead are a trend. And they think basically more price cuts are going to come and that investors should anticipate further price cuts, even if basically Tesla isn't the one cutting. See, they say here, one of the reasons analysts believe prices will continue to drop is competition. If Tesla doesn't cut prices, someone else will. That's Morgan Stanley's take. I actually completely disagree. I completely disagree with this. So why do I disagree? Well, I believe that the entire industry doesn't have any room to cut prices anymore. BYD takes 3% to net. Tesla takes 17% to net on electric. Well, that's actually the entire business for both of those companies. Then, when you look at Ford, GM, and Volkswagen, they're basically all losing money on their EVs. How can the rest of the industry cut prices? They can't be a price leader because they have no PP. They have no pricing power. They don't control price. Who controls price? Tesla does. As soon as Tesla cut, what happened? NIO, BYD dealerships, Volkswagen, Ford, GM, all of them cut prices. They didn't cut prices first because they can't. Tesla did. So I actually disagree that even if Tesla doesn't drop prices, others will, and then that'll somehow subsequently lead Tesla to cut prices. I don't see that, but maybe. Now, in response to Commodities Steve, my boy Steve over here, this is the only person that my son knows because he knows that Steve likes gold, like Steve from Minecraft. Steve says Volkswagen is spending 180 to 190 billion on battery plants and securing raw material supply over the next 5 years. That's a huge amount of money. What will hurt Volkswagen is higher energy prices in Germany due to no more natural gas from Russia. The raw material price of battery metals is not going to drop between now and 2026. It will stay roughly flat or increase. I think increase. Well, in fairness, Steve is all in on the comms, all in on the commodities. I'm not. I don't think commodities actually have pricing power. But I got this for you, Steve. I had to do it, man. I had to do it. Morgan Stanley and the Reuters piece here. Falling lithium prices have also contributed to price cuts. Spot prices for China's lithium carbonate have fallen sharply to just below 40K a ton, as the latest data shows China's battery production is still significantly exceeds installations. In other words, a glut of battery supply is sort of building up. And that is because, to some degree, EV demand is slowing. So we are actually seeing some of that slowing start affecting commodity prices. I personally am of the mindset that commodities, while they might be necessary, I think they have hit a sort of a speculative bubble where they have speculatively been ridden up because people believe they're going to be so necessary. And I think that is creating a little bit of a bubbling there. Now, don't get me wrong. Commodity prices are still substantially higher than where they have been in the past. But the point of this is not to discredit Steve, even though that would be fun, and I'll still have a beer with Steve. I understand commodity prices are still higher, and I respect Steve. What's worth noting, though, is that this is actually a very good thing. Whom is this good for? Whom is this good for? It's actually good for EVs that are still selling, which would be like Teslas, right? As it compared to like Fords, where your production line is stuck. Or GM even shut down their production line for a period. So whom is this good for? Well, it's good for EVs that are still selling. So that would be Tesla and BYD. But whom else is it good for? Well, it's also good for battery sellers like Generac and Enphase when those battery costs come down, right? So that's it's actually a good thing. So we are prepared for price cuts to be an established feature, though, says Morgan Stanley. As supply-demand continues to change, we would prepare for potentially lower margins, and that could potentially create more opportunistic entry points for the stock. Okay, that's where I have to actually somewhat agree with Morgan Stanley. While I do not believe that other EVs are going to drive pricing cuts at Tesla, I do think Morgan Stanley is potentially correct in that, yeah, maybe lower margins are going to be coming. And I think Q1 is probably going to hurt for Tesla, and maybe that's why Elon Musk, to kind of go full circle, is yapping about this idea of a 25 BP cut. The reason for that is I really think that Elon, I mean, we know this. We know he has an early look on this. We know in the last earnings call, the expectation set was that margins could go down to 20%, but I don't think Wall Street is convinced that we're going to get 20% yet. So I'm a little nervous for that next earnings report, combining Elon, Morgan Stanley, and what was said in the last earnings call. I'm not short-term YOLO Tesla. I do not believe we're going to revisit the lows we've had on Tesla. Could we trade sideways and maybe test that around the ones? I don't know that we're going to even break 170. If we do, it wouldn't be that great, but 170, 175 around there's got some pretty good support. I just don't see us escaping from that until after we get past the Q1 era, unless, of course, we had an incredibly bullish Fed tomorrow, which is always a potential, but I remain unconvinced. Bottom line out of all of this, coupon code expires tomorrow. Get life insurance in as little as 5 minutes. Get 12 free stocks with Webull. Tesla bottom line. Short term, little bearish. Elon margins. Short term bearish, especially through this next quarter report, which comes out in April. Probably around 420, actually. Actually, I wonder if it's scheduled. That would be funny. Let's see here. Tesla earnings report date. Let's see if, missed opportunity, 4/19. So that's less than a month away. We've already got Tesla earnings coming up. So I think you're going to have a fear trade going into Tesla earnings. Usually Tesla stock trends down after earnings and after events. Any kind of events tend to push Tesla down lower as well because, well, the events are just not as juicy to the broader Wall Street market. They're juicy to long-term investors. They're fantastic for long-termers. But in the short-term, events and reports seem to be more negative than positive. So anyway, 4/19, mark your calendar for that. I do actually think that eventually these falling commodity prices will help, but I don't think they're falling quickly enough to actually get Tesla back to higher margins soon. Remember what they told us in the last earnings call? In the last earnings call, they said, yeah, probably trending closer to 20%, and then it'll take us a few years to get back to 30% margins. So they did set the expectations, but I personally think nobody really paid attention to what they said in that earnings call. So I think there's going to be a little oopsie-doopsie there. So we'll see. But yeah, Elon asking for a 50 BP cut, I think, is a little bit of a red flag too. So again, short-term bearish, long-term bullish. I really don't think the competition has pricing power or holds a candle, but I'll use it as a buy the dip off. Now, after I recorded this segment, Cathie Wood actually gave her perspective. So let's go ahead and play that for you now. But remember, coupon code expires tomorrow. It's going to be a big price increase, so lock in that price and you get guaranteed lifetime access to all of the new content that's added, the course member live streams. You get guaranteed best pricing, and any new lectures that are added, you get totally for free to those courses. So it's a great deal. Check it out. Link down below.
And the real beneficiaries are going to be companies who have AI expertise, domain expertise, and critically, a large body of data. And we think Tesla, the largest position in ARKK and ARKQ, and we even own it in ARKW because it's an AI company. It is probably one of the most important AI beneficiaries in the form of autonomous taxi platforms, ultimately, which are powered by AI.
Got to ask you about Tesla, Cathie. I know you're one of your favorites and your top holding still. Always a battleground. The latest concern from investors is about margins. So they've been taking these price cuts, which we debated last time. And even if that's catalyzing demand, at what cost? Is that a reason for concern?
Well, I think Tesla has, and Elon Musk in particular, has said that he will pass along any cost declines that Tesla is enjoying. And I think that's what's going on right now. And I think he's in a position to drive prices down much more quickly than most other manufacturers, save for some in China. And I think there's deflation in auto prices taking place in China. I think Tesla led that and BYD followed. And so there's a deflationary tug there, which is actually going to accelerate the shift from gas-powered vehicles to electric vehicles, which is something that Tesla wants. So we think the mistaken assumption here is that Tesla has to cut prices because of competition. Tesla, we think, can drive prices down because its costs are moving down, particularly battery and drivetrain costs, faster than most other manufacturers.
So I think the key out of what Cathie said, while a lot of it is similar to what I said, maybe she was watching me as I... No, I'm just kidding. I'm not trying to do... I don't actually think that. I think many people can have a very similar opinion. But I think the key to what Cathie said here is that Tesla is the leader, and they can drive those price reductions because they are the leader. Unfortunately, though, I do think we're not 100% at that level yet. That is, even though Tesla is the leader in pricing cuts, their margin will suffer short-term first, and then in the long run, I think, come back. So I think right now, Tesla, if I were to, you know what, maybe I can visually describe this a little bit better. I think Tesla right now is shooting ahead of the running deer. And so that's a fancy way of saying, look, if this is a deer right here, there we go. There, it's got horns. I don't know, do deers have horns? Whatever. So here's your deer, and it's running that way really fast. You want to point your gun, depending on how far away you are, kind of like here, right? Something like that. I don't know, maybe that's not the best kind of reticule. Whatever. Anyway, you kind of want to aim here. So in my opinion, this is a little bit of what you're getting with Tesla. So the way this would work is drop prices, cut prices to where margins drop to 25% or to 20% from 25%. Then once you hit your target, you get the loot and you end up going back to 25 to 30% as your cost declines actually catch up. but I do think we still have this period of time ahead of us. But yes, I agree with Kathy Wood. Otherwise, I hope you enjoyed my deer drawing. If you want more of those, well, you're going to have to get life insurance in as little as 5 minutes. Link down below by going to mettkevin.com/life and get yourself 12 free stocks at Webull to basically pay for your free life insurance. Yes, paid promotion, but pay for your life insurance by getting 12 free stocks at Webull. How cool was that? mettkevin.com/Webull, mettkevin.com/life. Link down below. Thanks. Bye.